goes manufacturing, whoever it is, they've been there 20 years in this particular facility, and they're selling the property, but they are not moving out. And simultaneously at closing, we're signing and executing this very long-term institutional grade lease, 15 to 20 years, absolute triple net leases. Really, that's our gold standard. We're here to buy operating companies. Many times that purchase comes with a real estate. And so we're basically a real estate partner to them, sometimes as they're acquiring the business, and sometimes it's years later. But they're saying, look, we want to free up this capital here, either to, add acquisitions, sort of lower our basis, again, or just keep our money out of the real estate because we can't do that. Or it might be years later, like I mentioned, where they say, okay, we want to take this company to the next level. We've performed A, B, C, and D, companies doing great, but we want access to capital. So this is a financing instrument for a seller. So if they're looking at leverage ratios, for instance, maybe they have a piece of senior debt on there and they go, well, we could free up $10 million capital here, and it doesn't put additional leverage, doesn't affect our debt to EBITDA ratio, whatever that is that they're trying to balance out. It's very flexible capital for them. And usually it's much cheaper than a senior loan that they would get. So it's a little different. And now you start to look at what kind of cap rate, their effective payment on that loan, if you will, or that capital that they're freeing up. I mean, we look a lot like a private equity shop when we're in due diligence, right? I mean, there are many, many hours of phone calls with the management team at each one of these tenant companies. We don't look like your average residential real estate investment shop, because we have a team with, I call it 4.5 and aspiring credit analysts on there too. But these guys are, the top two guys are 10 plus years institutional experience of corporate credit analysis that they've had from publicly traded REITs. And we brought these guys and continue to build that team. We've only had one tenant ever default in the course of that time. They're absolute triple net in terms. So we can go, look, our rent actually equals NOI, which is, sometimes surprising to some people, but there's truly no exposure to expenses there. So what that makes for is this really predictable cash flow, right? Yeah, 2.5%, 3% is pretty typical for what we see out there. Well, a fund of, 25 properties with 25 different tenants in different industries, so they're not concentrated, and that's very nice to have should we run into a vacancy, unlikely as that is, or even several vacancies, and still be able to support debt service. So yeah, as far as investor returns, generally we're targeting mid to high teens IRRs on all these, and the cash flows generally we're targeting 7 to 8%, right?
How do investors learn more about MAG Capital?
My email is drew@magcp.com. Or they can go to our website, magcp.com. So we just kind of transitioned to MAG, a capital partner.